Monday alert. The unthinkable has begun. Silver's historic revaluation is underway. Something just broke in the global financial system. Not gradually, not slowly, overnight. And if you're watching this on a Monday morning, you need to hear what I'm about to tell you, because most investors will spend the next 6 months wondering what happened. You have a chance to understand it right now. Silver is moving, and not in the way the mainstream media is reporting. This isn't a trade, this isn't noise. What we are witnessing, right now, in real time, may be the single largest monetary revaluation of a physical asset in modern history. Stay with me, because by the end of this video, you will understand something that the majority of even experienced investors completely miss. Here's what most people think is happening with silver. Prices are going up because of some industrial demand story, maybe some tariff news, maybe a Fed comment. That's the surface. That's what the financial media feeds you. What's actually happening goes much, much deeper. We are watching the simultaneous collision of three forces that have never converged quite like this before. Monetary policy failure, a structural physical supply crisis, and a global geopolitical realignment that is quietly destroying the foundation that kept silver artificially suppressed for decades. I'm going to walk you through all three, and by the time I'm done, you'll understand why the word unthinkable is in the title of this video, and why it's completely accurate. Build Authority, Part 1, the Monetary Foundation. Let's start with money, because this entire story begins and ends with money. Since 1971, when President Nixon ended the dollar's convertibility to gold, the global financial system has operated on pure faith. Faith in the US dollar, faith in US treasuries, faith that the numbers on the screen actually represent something real. For decades, that faith held. The United States could run deficits, print dollars, and export inflation to the rest of the world. Other countries had no choice. They needed dollars to buy oil, to trade, to survive. But here's what's changed. The U.S. national debt has now crossed $36 trillion. Let that number sit for a moment. $36 trillion. If you spent $1 every single second, it would take you over 1 million years to spend $36 trillion. And we're adding to it at roughly $1 trillion every 100 days. Now, here's where the Federal Reserve becomes the central character in our story. The Fed is trapped. If they cut rates to stimulate the economy, they risk reigniting inflation. If they hold rates high, they risk a debt spiral, where interest payments on that $36 trillion start consuming an ever larger portion of the federal budget. We're already spending more on interest than on the entire defense budget. There is no clean exit. There is no painless solution. And historically, every single time a major currency entered this kind of debt trap, hard assets repriced: gold, commodities, and silver. But here's the part most gold investors miss entirely. Silver is not just a precious metal, and understanding why is the key to everything I'm about to show you. Build Authority, Part 2, the supply crisis nobody is talking about. Silver sits in a completely unique position in the global economy. It is simultaneously a monetary asset and an industrial metal. And right now, both sides of that equation are pulling in the same direction. Let's talk about the supply side first. For the last 4 consecutive years, the global silver market has run a structural supply deficit. That means demand has exceeded mine supply plus recycling. 4 years, consecutively. The Silver Institute, which tracks this data more carefully than almost any other organization, has projected that 2026 is on track to record one of the largest deficits in history. We're talking about a gap between supply and demand, measured in hundreds of millions of ounces. Where is this industrial demand coming from? Solar panels, electric vehicles, 5G infrastructure, defense electronics, medical devices, AI, data centers, which require massive amounts of silver-intensive electronics. Every green energy panel you see on a rooftop contains silver. Every electric vehicle has roughly 2 to 3 times more silver than a traditional combustion engine vehicle. The energy transition that governments around the world are mandating, it runs on silver. And here's what makes this structurally dangerous. You cannot print more silver. You cannot create it with a keyboard. When a central bank needs more money, it can create it overnight. When the world needs more silver, someone has to dig it out of the ground. The average time from silver discovery to production is 10 to 15 years. That pipeline is not going to fill the gap that's opening up right now. Meanwhile, physical silver inventories at the COMEX, the main US futures exchange, have been under persistent pressure. There have been repeated instances of delivery stress, situations where the paper promises of silver contracts began to bump up against the uncomfortable reality of how much physical metal actually exists in registered vaults. Most investors have no idea this tension is building beneath the surface. Smart viewer psychology. Here's what separates the informed from the crowd. Most retail investors look at a silver price chart and see lines going up or down. They react, they chase, they panic sell. What institutional players and the small minority of truly informed investors understand is that the price is not the story. The price is the last thing to move. Before the price moves, fundamentals build, quietly, invisibly, sometimes for years, and then something breaks the dam. We may be at that moment right now. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically oscillated between 40 and 80. Whenever it is pushed to extreme levels, silver has violently corrected back to historical norms. Right now, even after silver's recent move, that ratio remains historically elevated. The math alone suggests that if gold holds its current levels, silver has a substantial revaluation gap to close. But that's just the math. The real story is geopolitical. Build Authority, Part 3. The Geopolitical Realignment. Something is happening at the structural level of the global monetary order that has no precedent in the modern era. BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of new members, have been systematically reducing their exposure to US dollar-denominated assets. Central banks globally have been buying gold at a pace not seen since the 1960s. According to World Gold Council data, central bank gold demand has been running at record levels for multiple consecutive years. Why does this matter for silver? Because the de-dollarization trend, the slow, grinding shift away from the US dollar as the world's reserve currency, is fundamentally a vote for hard assets. When nations stop trusting paper promises, they reach for things that are real, things that cannot be printed, things that have intrinsic value regardless of what any government decides. Gold has been the primary beneficiary of this shift, but silver, undervalued, underowned, and sitting on a structural supply deficit, is historically the asset that plays catch-up when gold leads. And there's another layer here that almost nobody is discussing. The Shanghai Futures Exchange has been quietly establishing itself as an alternative pricing mechanism for silver. For decades, silver pricing has been dominated by the COMEX in New York and the LBMA in London. But as Eastern demand grows, particularly from China's massive industrial base, the center of gravity for silver pricing may be shifting. If that happens, if silver pricing begins to reflect Chinese industrial reality rather than Western financial paper markets, the repricing could be extraordinary. Emotional wave, fear to understanding. I want to be direct with you for a moment. I know this can feel overwhelming. When you start to see how interconnected these forces are, monetary policy, supply deficits, geopolitical realignment, it can feel like the ground is shifting beneath your feet. That's actually an accurate feeling. But here's the distinction that separates panic from preparation. Panic is reactive. It happens after the crowd figures it out, after the headlines scream, after the price has already moved. Preparation is quiet. It happens when you understand the mechanisms before they fully play out, when you can look at a set of converging forces and reason forward, not backward. The people who positioned in gold when it was trading at $1,200 per ounce, before the debt crisis fears fully materialized, they weren't lucky. They understood the framework. They saw where the math was pointing. The same framework, applied to silver today, points in a direction that is difficult to ignore. If central bank gold buying continues at current rates, and there is no structural reason it should stop, gold's continued strength historically pulls silver higher. If the industrial supply deficit persists, and the green energy transition is a multi-decade structural driver, the physical scarcity premium grows. If the Fed is forced into an easing cycle, either by recession, by financial instability, or by political pressure, real yields fall and monetary metals typically benefit. These are not predictions, these are conditional observations. If these conditions hold, history suggests the path of least resistance for silver prices is significantly higher. But here's what I haven't told you yet. The part that even silver investors don't fully appreciate. The mechanism that could make this move violent rather than gradual. The paper-silver problem. The COMEX silver market operates on a ratio that should concern every investor. For every single ounce of physical silver that exists in registered COMEX vaults, there are dozens, sometimes hundreds, of paper contracts representing claims on that silver. These are futures contracts, options, derivatives, financial instruments that create synthetic exposure to silver without actually requiring anyone to hold physical metal. This works fine until it doesn't. The system relies entirely on the assumption that most contract holders will never demand physical delivery, that they will simply roll their contracts, take cash settlement, or close their positions before delivery month. But what happens when sentiment shifts? What happens when enough market participants decide they want the real thing, not the paper promise? We've seen glimpses of this. Hunt Brothers in 1980, the Reddit-driven squeeze attempt in 2021. Each time, the paper market was stressed in ways its architects didn't fully anticipate. The difference today is scale. The industrial demand is real and growing. The monetary demand is real and growing. And the physical inventories available to back the paper promises have been under pressure. If these forces converge, if industrial buyers, monetary investors, and Eastern physical demand all press simultaneously against a paper market that is being stretched beyond its physical backing, the repricing mechanism could be swift and severe. This is not a certainty. Markets are complex. Authorities intervene. Rules change. But the structural setup, the coiled tension between paper claims and physical reality, has rarely looked like this. Historical anchoring. History doesn't repeat, but it rhymes. In the late 1970s, as the US wrestled with runaway inflation, a collapsing dollar, and the aftermath of abandoning the gold standard, silver went from under $5 an ounce to nearly $50 in a matter of years. That's a roughly 900% move in one of the most chaotic monetary periods in modern history. In the decade following the 2008 financial crisis, as the Federal Reserve embarked on an unprecedented experiment in quantitative easing, silver went from under $9 to nearly $50 again, before being aggressively sold back down. Each time, the mechanism was the same: monetary uncertainty, dollar credibility questions, and an asset that had been suppressed relative to its fundamentals, suddenly repricing to reflect reality. We are now navigating what many serious macroeconomic analysts consider the third and potentially largest iteration of this cycle. The debt levels are higher than they've ever been. The geopolitical fractures are deeper. The industrial demand is structural in a way it wasn't in previous cycles. The question isn't whether silver will eventually reflect these fundamentals. The question is when, and whether you'll understand what's happening when it does. Call to smart viewer. Here's the reality of the moment we're in. The financial mainstream is still largely treating silver as a commodity trade, a cyclical bet, something you hold when inflation is hot and sell when the Fed sounds hawkish. That framework is outdated. The investors who are going to look back on this period with clarity are the ones who understood that we are not in a normal business cycle. We are in a structural monetary transition, the kind that happens once every several decades. The kind where the assets that get revalued are the ones that sit outside the paper financial system. Gold understood this first. Bitcoin, in its own way, made a similar argument. Silver, the most undervalued of the monetary and industrial metals, may be the final piece of this puzzle to reprice. And when it does, the move tends not to be gradual. It tends to be sudden, violent, the kind of repricing that happens before most people have time to react. The informed minority acts before that moment. The crowd chases after it. So let me leave you with this. We are living through a Monday that feels like a lot of other Mondays. Markets open, numbers move, analysts talk. Most people scroll past the headlines and go about their day. But beneath the surface, in the vaults, in the futures markets, in the central bank boardrooms, in the supply chains of solar manufacturers and EV companies, something is building. Something that has been building quietly for years and may now be reaching an inflection point. Silver has been called poor man's gold, a speculative metal, an afterthought. I think history will remember this period differently. I think history will record this as the moment when one of the most undervalued, structurally mispriced assets in the global financial system began its recalibration. Slowly at first, then, as these things always go, all at once. The question I'll leave you with is simple. When that moment arrives, when the paper market meets physical reality, when Eastern demand meets Western paper, When monetary fear meets industrial scarcity, where will you be standing? On the side that understood what was coming, or on the side that watched it happen and wondered why nobody told them? This is your briefing. What you do with it is up to you.